All right, stocks were largely mixed today, up in some areas, down in others, but very small range again, very similar to what we saw yesterday as we head into a very important jobs report tomorrow morning. Before the market opens, we'll get this jobs number. It seems like we've been getting some pretty decent numbers. So the market, as I'll show you in today's video, it seems like the market is setting itself up for there to be a bounce to the upside. But with the skew as high as it is and the VIX as high, so I'll show you those charts, there is a lot of concern. There are some patterns that show there is a lot of concerns that things can turn south in a big way starting tomorrow. We've seen precedent for that the last couple of months, actually, in September and August, at the very beginning of both of these months. And we'll see if October follows suit with the same kind of pattern. It seems like the market is there's a lot of people concerned about that. You'll see that in the sector rotation as well. A very interesting pattern. In fact, a very familiar three-headed monster popped up its head today as well as for most of this week and are showing some very interesting patterns across the three different asset classes that make up that monster that has in the past, in the relatively recent past, impacted risk appetite negatively. So we'll take a look at that. We'll take a look at our trade idea of the day. We've had one trade earlier this week in the same area, same sector, where that stock was really dropping down to 52-week lows pretty significantly. This stock has been kind of following the same pattern, just not as big in a rush. So we'll talk about how to trade that stock with today's trade idea. So let's go ahead and get started. Today is Thursday, October the 3rd, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, stay in them, get out of them. We talk about that, how to manage them. We also put on today's trade idea already before the market close here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit the like button on today's Market Outlook right there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the market forecast with the look at the S&P 500, with the market forecast indicator. You can see a little bit of weakness we've had in the past few days. Nothing too alarming. We still don't have a bearish low point on the near-term line. We talked yesterday, at least in our Market Scholars classes, about the possibility of a bounce. Obviously, we didn't bounce today, but we're still kind of set up for a bullish near-term low point. The momentum line is not oversold. The near-term line is barely in bearish territory. So, and again, this is the second day, and it didn't get into the lower reversal zone. So again, it's not 100% probability, but still a pretty decent probability, like we did over here, that will bounce up and come off of this low and get that near. Again, we'd have 2 days to go from being below 40 to above 80. Ideally, you'd want tomorrow's momentum line to jump pretty high and get like it did here and get up above 80 tomorrow, and that would ideally push the near-term line above 80 on Monday, right? That would be the kind of the ideal scenario, and you know, that would be kind of where I'd be leaning, right, from a probability standpoint. As to what we might see on that chart. If I look at the NASDAQ 100, it's very, very similar. You can see, again, the market sentiment's rising. The intermediate line is out of the reversal zone. We did get a yellow line. You notice we didn't get a bull tag, though, because we didn't cross below. The moving average is actually falling on the NASDAQ 100, even though we're above it. You have to cross below it, a rising moving average, for it to be a bull tag. That's not the case right now. We are barely below 82, so it's barely light pink shading. And you can see as well the near-term line, has now, how many days has it been now since it crossed below 60? So this was day one, and the momentum line was oversold. But then we've, 1, 2, 3, 4, 5 days, and the near-term line has not been able to get below 20. So again, not very likely that it will. And actually, the near-term line rose today. It didn't get above 40. Tomorrow probably will, and where the momentum line is tomorrow will gauge where it ultimately will be. And considering the jobs reports coming out tomorrow, And considering that, I would probably guess the market will have a positive reaction to the jobs report. As you know, that's kind of what the market's been doing lately. The economic surprise index, which kind of gauges where the market has been doing relative to its the estimates for all these different economic indicators, especially the ones that impact the volatility in the currencies the most. Right, you can see it's back to being positive. So I would expect the market will probably have a positive response to the jobs number tomorrow, which means you can see now why, especially if we close at the high of the day tomorrow, that momentum line jumps to a pretty decent level. The near-term line comes out of bearish territory, maybe even into bullish territory, and then we have Monday to get it up above 80, which we would most likely if the near-term line gets. And you would also, it would be a cross up above the intermediate line by Monday too if that happened, with the intermediate line between the reversal zones. So that would be a very good sign for the markets if that ends up happening. The near term line for the Dow never did get into bearish territory. It crossed below 60. So that's what we kind of watch for. It's crossing back below 60. So, but it has been now 1, 2, 3, 4 days of being below 60, and it can't even get into bearish territory. So again, you're likely, despite this little weakness, that the near term line will bounce back up. And then finally, your Russell 2000, which is probably the most bearish today, which is why we've had that, why the breadth is looking so bad. This would be the one thing that could impact us negatively. Now, it's a bull tag, so we can bounce right off of that, as we've seen, right? We can bounce off of these and bounce right back up. So even like this one right here, we bounce right back up immediately. If not immediately, then pretty soon. But bull tags can also start these bearish runs to the downside, right? As we saw in 2020, in 2023 when we started that decline, as we saw here earlier this year when we started this decline, and as we've seen on all the other intermediate declines, they'd start with bull tag. So this is the first bull tag. We got a bearish near-term peak here. We did get into in 2 days. We did get down. Now, not very much. So we're not too extreme on that momentum line. We're not too deep yet on this near-term line. So we could bounce like we did here. But coming off of a bearish peak, the intermediate line is falling, and getting that bull tag. So that is something. If breadth continues to deteriorate and the Russell 2000 continues to look pretty bad, then that, you might see the rest of the market kind of doing the same thing. So it's going to kind of depend upon, again, how the market responds to that jobs number here tomorrow, and whether or not we can get all of these signals to really bounce back up towards bullish levels here tomorrow, and then into next week, into Monday of next week. Let's take a look at the weekly chart for the S&P. Of course, I mentioned before, we're 1 day away, right? If we can get a good day tomorrow, we can get a Hakinyasha close, maybe a little bit above this. We're not very far. 57.29 was last week's Hakinyasha close, 57.16. So if we can get a good move up, we're at 5700 right now. So we'd have to really get a good strong move to bring that Hakinyasha close up. Getting a lower close, it makes us susceptible to transitions. As I mentioned to you before, the Russell 2000 actually is forming a transition candle this week. And it's not the most bearish candle, but it's a relatively bearish candle here. So that's a little bit of a negative sign going into this jobs report. But that lower close here, the NASDAQ 100 is not as bad, but it is a lower close and a pretty small, like the size of the body breaking below its average. So little signs of weakness there. Obviously, you don't have 3 green arrows anymore. In fact, you have 3 red arrows. As I mentioned, you got that bull tag on the Russell 2000. So you have 3 red arrows right now. But 3 red arrows doesn't necessarily mean that we have to. We got 3 red arrows over here and we rallied. So 3 red arrows doesn't mean we have to start an intermediate decline, though we always start every intermediate decline with 3 red arrows. So that's something to kind of keep an eye on, especially as we're getting weakness. 2 reds, 1 red, almost 2 reds here. We'll see if tomorrow's kind of a pivotal day. It could either bounces back up or produce the 3 red arrows across the board on all these indexes, depending upon how the market has been reacting more to the jobs reports lately, more so than the inflation reports. that we've been getting. It had been really reacting to the inflation reports quite a bit, and now it's the jobs reports that it's reacting the most to. So really important day tomorrow from that regard. Looking at the 2-line version of this chart, we are again in a convergence mode. That's where the MACD crosses below the moving average, but we are not below the 17-day, much less the 30. So we're still doing okay. We're below the 8. There's a little bit of weakness, but we're not below that 17-day. Obviously on the Russell 2000 we are, because we're below the 17 and the 30 right now. We haven't broken that 50 yet though. So again, that bull tag, we can really bounce up here and really get going into the upside. Or if it breaks the 50, then we're looking for a move down to the 200, and that's what a pullback is, a break of the 50-day and a move to the 200-day. That's your definition in this chart of what a pullback is. Remember, a correction is when we break the 200-day and start working our way lower, though you'll have pretty strong support at the 200-day moving average for the Russell 2000 and for the S&P. It's not the point of control, but pretty much is. They are pretty close to being the point of control. So if we were to make a move, a pullback move down to the 200-day, you can see why, at least at first, how we'll get that pullback bounce. Whether that pullback bounce fails or not remains to be seen. But you can see how we'll get that pullback bounce there, because there's a very strong level of support down there. If you take a look at the DMI, again, you can see a very rare condition. It is extremely rare for both the positive and the negative indicators, and obviously the ADX2 now is down there, but for them both to be below 20 is extremely rare for them both to be below 20. So it kind of goes to show that one of these is going to bounce back up, and again, a pretty decent chance it would be that positive indicator, since it's already above the negative and it's barely below 20. So a pretty good chance that that's the case. The negative indicator, they are not both below 20. They are both close to 20, but you do have the bearish crossover with this little bull tag we've gotten. The negative indicator has crossed above the positive, but again, because the net positive is barely below 20, we are kind of at this kind of point where you could bounce right back up. And same thing like right here, you could bounce right back up. Even over here, you're barely above 20 and you bounce right back up. So we're at that level here where you're barely below 20 and you bounce right back up. So we're kind of at that point where we could bounce right back up right now. Again, with that pause. So we're kind of setting this environment for tomorrow's jobs report for the market to bounce back up. It kind of seems like that's kind of the scenario that seems to be unfolding right now. Your RSI and the CCI is still at relatively bullish levels, barely below the 0, but definitely not below minus 100. And then we are below 60, so we're not bullish anymore there, but we're not in the lower half of the chart yet either. So we're still doing okay on those. And then if you look at the Ichimoku cloud, we are still up well above the cloud, still well above that blue line. So we're not, remember the blue line is the midpoint of the last 26-day range. We're still in, clearly in the upper half, even if we're below the midpoint of the last 9 days range. But that's okay, right? We're still got a positive 26-day rate of change. We still have a intermediate strength trend on the S&P, so we're not, anywhere near, a pullback yet right now, per se there. And then you look at the Bollinger Bands and the Keltner channels. Of course, we are not in the upper quartile, haven't been for a few days now, but at least we are still in the upper half of the bandwidth. The bandwidth is starting to decline. You're starting to lose a little bit of momentum. But again, you can lose momentum, as you can see here, and still be bullish. Getting these dark blue bars. You can get these dark blue bars and still be slightly pointed higher. We are not above the Keltner channel. Never did get above the Keltner channel in any of these two bullish moves. And so we'll see, how we react here tomorrow and whether we're able to get closer to the Keltner channel or above it after tomorrow's jobs number. If you take a look at today's today's intraday range, pretty much same range as yesterday. Very, very small range. The PPO, the Arun indicator, both of them are falling here. It is an equal high. We closed right at last week's low point. And you can see, again, a break above 570 would really get us going up towards 574, which would set us up for, again, more of a sustained bullish move up to the upside. Whereas a break below yesterday's low, you can see, in filling in the rest of this gap here, there's not very much support on an intraday basis below that. So You know, you can see how, again, we're at a pivotal point where we can maintain the bullishness, and a lot of the patterns suggest that. But if we don't, then we can, we can start to be more of a pullback scenario as we break down into these lower levels. You can see here as well, when you look at this chart from this perspective, we're not very far from breaking below the average, right? Which is bearish when you break below that average there. So really, really important day, technically speaking, which is why for a second straight day, you got very low range and you got very low volume. You're going to get a big range tomorrow, most likely, because that's what we've seen. So it probably will get a very big range. Hopefully it's a big enough range to get you through these old highs, maybe even gap up above those highs. And then we can start looking for smaller ranges to get us back below that 1% mark. But, a lot of people are worried about tomorrow. That's why the VIX is up. It closed up above 20 today. Did not close above 95% relative to VIX 3M. Your VVIX closed above 110. So that's a high level, again, suggesting that we could get a big move tomorrow on the VIX. But, if the market really responds favorably to this jobs report, then that VIX drops back below 20, drops back below 90%. This drops back down below 100, and everything is fine, right? So, but there's a lot of concern in the markets, and that's why the VIX is pretty elevated, relatively speaking. It's above its all these moving averages. It's 8 and 17-day averages across above the 30. So the VIX really doesn't trend very much, but it's trending right now in the positive direction. And with a VVIX above 110, like it was right here, the VVIX got above 110, or actually it was here. Then you saw what happened after the VVIX got above 110 when it rose up above 110. So that's the kind of move potentially we could get next week going into, I don't know if this was a jobs report, probably was a jobs report in early August. We might be looking at something similar. And there's another jobs report probably over here as well, and we might be looking at something similar again right now at the beginning of October. All right, now let's take a look at what's driving the price action for today. And again, you can kind of see, if I were to zoom in on today alone first, and then we'll look at the week that we've had so far. But let's look at today alone. And you can see here, commodities, big move up to the upside. The dollar, big move, it's up positive today. Those are the only two things that are positive. And then everything else is negative and yields are down. That's a very familiar pattern. We've seen this before. 2021 specifically, we've seen this before, into 2022. As we started to rotate into other areas of the market that were not XLK, and we ultimately had that three-headed monster really impact risk appetite negatively. And we're seeing that here again with that commodity price move. And if I were to zoom out for the rest of the week, you'll see a very familiar pattern, right? It's the same thing. Commodities up almost 4% this week, thanks to what's going on overseas. The dollar is up 1.5%, which is a big move in just 4 days for the dollar. And then finally, you can see the yields or bonds down here. One of the bigger losers, the small cap stocks down 2%, but bonds down almost 2% too, which means yields are up. So if I take a look at some of those charts, if I take a look at the yields chart, you can see it's actually doing a pretty nice little run. It's up above the 30-day or 50-day moving average. The 8 and 17-day moving averages are crossing up above the 30. So we're starting to get a little bit of a run up to the upside there. But as you saw on the weekly chart, we are above the 8-week moving average so far. Now the week's not over. We got one more day, but we're above the 8-week moving average for the first time since way back over here. We'd have to go all the way back to the end of May was the last time that we've been above the 8 weeks. So we're not above the 17-week. The MACD is not above its moving average yet. But you can see that's the direction we're trending towards right now on the 10-year yield. If I take a look at a similar pattern here, let's look at the dollar index, right, and see how the dollar's been doing. Again, very similar, flirting with that 50-day moving average. 8 and 17-day are crossing above the 30. The MACD and stochastics moving in the bullish levels. And you can see, again, crossing above the 8-week moving average. We're not above the 17-week yet. The MACD is not above its moving average yet, but you see we're moving in that direction as we are above the 8-week for the first time since, in this case, June 24. So about a month later than the 10-year yield, but June 24. So it's been, again, multiple months that we haven't been above the 8-week moving average, and we are now for the first time this month. And then finally, if you look at commodities prices, commodity prices in general moving back up pretty strongly after having breaking below the 200-week moving average, breaking back above all the moving averages in the past 4 weeks. You can see what it looks like on the daily chart, breaking above the 200-day moving average as well. So very significant change in direction for commodity prices. That's going to impact inflation expectations. You can already see that it has been as yields are moving up as well. But if you look at crude oil, which is one of the bigger drivers of that, it looks very similar to the dollar and the yields, right? We're moving above the 50-day moving average. The 8 and 17-day are close to crossing above the 30. The MACD and stochastics moving into bullish levels. And then you look at that weekly chart and you see that it is also not above the 17-week yet. MACD is not above its moving average yet, though it looks like it's trending that way. We are above the 8-week for the first time since July 8th, so a little bit later than 2 weeks later than the dollar, and about a month and a half later than the yield. So again, it has been on multiple months that we haven't been above the 8-week moving average, and now we are with a very good week here to the upside. That's a significant change in direction for these 3 asset classes, that when they have all moved together like this in 2022, it really put a damper on, and even like late last summer, it put a damper on equities then here in March and into April, and even in some of these other periods, especially when you look at like the dollar index earlier this year, here in March and April when we had the weakness there, and then we had some weakness here recently in August, early September, we had that positive week in the dollar. There's last summer's weakness in the market. So a change in direction in the dollar, especially if it's associated with a change in direction in commodities and yields, would be a significant change in direction for risk appetite. And this is coming at a time where breadth, which has been so strong, has changing dramatically. You can see we are pretty strongly negative, not below the minus 35 level, which is where you need to get to be trending, right? But it's close, and it's pretty easily negative. So we have 2/3 of our Hindenburg Omen for today. Though again, because we've been so bullish, we don't have a whole lot of new lows. You can see if I were to take a look at the new lows here, we'll take a look at the new lows index, and you'll see that it is here we go. Not moving up very much. In fact, so it hasn't been updated yet, but you'll see the new lows as of now is right around 27. So that's, again, 72 is the mark to get that third element of the Hindenburg Omen. So definitely not getting that today. But what is interesting is the number of new highs has dropped down dramatically. If I take a look at a 1-year chart on this, well below the moving average, right? So, which, again, suggests that the market is at best in convergence mode, which it is. I mean, when you take a look, as we said on the chart here, that the S&P is below, the MACD is below its moving average. We're not quite below the 17 days, so that's a convergence period. So that's what this is saying. At best, we're in a convergence mode. At worst, we're starting to consolidate. As you can see, the highs have really broken down below its 20-day average pretty significantly. The number of stocks above the 50-day moving average has also broken below its 20-day average with a move down to 366. Now that's 1 day, and it hasn't, it's just a little bit, so we can bounce right back up tomorrow. But that, you can see a significant breakdown from the peak there at 421 that we had. So breadth is falling there. If you look at the number of stocks above the 200-day moving average, also flirting with breaking below its 20-day average. Obviously, you'll see the number of new highs and new lows has recently. I mean, this will be updated later tonight, but this is also broken below its 20-day average already. So this strong breadth that we had, this extremely strong breadth that we had, that got that summation index up to such a strong level. But well above 1,000. Remember, the strongest level that we've seen since 2019, early 2019. Now it's gone negative. The breadth has gone negative, and we're starting to get weaker breadth. And if you take a look at like the sector rotation here today, we'll take a look at today first, and then we'll look at the rest of the week. But here is today's move on the breadth, and you'll see, okay, right? XOK is It's outperforming everything else except for energy. So it's still doing okay. Utilities is the only other sector outperforming the market. If I were to zoom out to the week, and you'll see that's not necessarily been the case. Technology, all the consumer stocks, discretionary and non-discretionary, are significantly underperforming the markets here, along with materials. Materials, remember, have been doing so well with that China stimulus last week, giving back some of those gains here so far this week. And then all the other cyclical areas kind of matching the market with small losses for the week. Utilities being, one outlier to the upside. Energy being by far the biggest outlier to the upside. And remember, when energy outperforms, that is not necessarily the best case scenario. Remember, that typically has a negative correlation with the stock market. You can see it has a 66% negative correlation when energy outperforms the market. That's typically bearish, and you can see the ratio is really breaking out here, breaking above its 50-day average after having been below it during this entire bullish run. You can see energy did well relative to the markets during the pullback of March and April. Did well here at the end of July, August period when we had that pullback in the S&P as well. And is really doing well right now. MACD is turning up higher. The long-term PPO has gone positive here. The histogram has gone positive. The CCI is at a bullish level that we haven't seen during the last pullback. You can see the DMI is looking pretty strongly positive. I showed you the RSI also getting above 60. We didn't do that during the last pullback. So pretty clear change in direction for energy. And that's not necessarily, again, as you see, not necessarily what we want to see. Here it is well above its averages and breaking above, like I said, the 50-day average here. And we've got strong bullish momentum, and now the relative strength is crossing above 100. We want to see that XLK is doing that. And it's trying, right? It's flirting with getting back above its 8-day. It's flirting with getting back above that ratio. And it's in that leading category, right? It's in this leading category here, but not nearly with the momentum that energy has. And you can see even the safety trades, which have been bearish during this little rally, they're turning up and starting to increase in momentum. Staples and utilities, you can see, has turned back up here. It's already in the leading category. Staples is turning up. Healthcare is turning up, even with the weakness that we see in some of the more discretionary parts of the healthcare that we've traded on here lately. And then real estate as well. So, it looks like, remember how I said that the weekly, we have a weekly rotation into safety, very similar to late 2021 going into 2022, that we typically don't see that kind of rotation in just pullbacks, right? That's the type of rotation you get when we start to get corrections. Well, after having some weakness here that's brought this momentum down over the past couple of weeks, this is a 2-week chart here. After having a couple of weeks of weakness, now the momentum is picking back up, and we're starting to see some of these areas outperform. Of course, utilities is just killing it, so it's still well above its average. But if you look at like XLP, which has had a little bit of a pullback below the last couple of days, breaking below these averages here, breaking below its relative strength, but that momentum is picking up, and you would expect soon that the relative strength will pick up off of that really low level, and we'll see how much longer this type of pattern will last. And remember, the really important ratio that we kind of watch to give us another sign of risk aversion or risk appetite is XLY relative to XLP, and it's had such a good gain during this bullish move in the markets, and to get back to the 200-day, but it so far would be failing at a weaker level than the last time it failed, right? When it failed up here, and even though the MACD was actually a little bit stronger and the CCI, but we had a failure there, and it looks like we may be starting to fail again on this ratio. And if we were to break down, of course, that would also be coincident with an increase in risk aversion. All right, well, that brings us to our trade idea of the day. And today the trade is on Merck. As you can see, Merck has been bearish already throughout that late July, early August period. Tried to rebound, failed in its rebound, has rolled back down with a bearish intermediate peak back into the reversal zone. And then this bearish short-term sentiment plummeting the last 2 days to get to extreme bearish levels, producing a cluster. In this case, a little different cluster than you'll see here when we get to the chart. We're not as far below the moving average now as we were then, about half the length. So opportunity for some more downside. You can see that as well when you look at its weekly chart. Its weekly chart is turned bearish, the lowest close of the year, as we close below all these lows and closing below a lot of the, or all these closes, excuse me, closing below a lot of the low points. A pretty bearish candle too, a relatively decent sized bearish candle, and the PPO going down to its lowest level of the year. As you can see, not the lowest level, ever, right? This is hardly the lowest level ever. As you can see, it can get a little bit lower, but it is the lowest level of the year, as we are in a death cross environment right now on the stock. Obviously, you have 3 red arrows on the stock. We have the 3 red arrows there moving lower. You can see some increased volume yesterday on the breakdown is when we closed below that, and today continuing with that breakdown. If you take a look at the 2-line version of this chart, you can see we're breaking below the value area on the 1-year chart, breaking again, closing below all these lows. MACD is bearish, stochastics in the lower reversal zone, pretty bearish as well. When we take a look at some of these other oscillators, you can see the DMI is just turning up. Again, last time we got that cluster, the ADX was pretty high. It was at 29, almost 30. Now the ADX is not even above 20. So we're just kind of getting started on a new move. So a little different environment there. Looking at the RSI and the CCI, you can see kind of similar patterns. We were extremely low back here when we got that other cluster on the RSI, and the CCI not so much, a little bit more sustainable bearish pattern that we're developing as the Ichimoku cloud is also developing into, again, was a very mature level when we got that cluster over here. It's just starting a new bearish intermediate strength trend right now. And then finally looking at the Bollinger Bands. We did break below the lower band then and made a big run up into the upper bandwidth. Is when we got the cluster, actually, is when we had this spike already up here. We're just starting to move up, obviously a lot slower because we don't have the earnings coming through, again, below the value area. And the bands themselves, as they're increasing, are breaking outside of the Keltner channels. You got the green dot, increasing bearish momentum, closing below both the lower band and the lower Keltner channel. So what I decided to do there was to do a long put vertical spread, sell that low 30s delta, happens to be a 28 here, buy the 110, gives us about, let's see here, gives us about almost a 2-to-1 reward to risk ratio, a little bit less than a 2-to-1. A lot of flexibility on the timing, considering how bearish it has been. So it gives us some flexibility there to let it work out and see what ends up happening as we get below into an area where there's just not a whole lot of support. In fact, we can go all the way here below down to this 105 level, which is what we've sold, before we really run into the next significant layer of support on that 1-year chart. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.